Okay, so we are recording now. So those of you who have chosen to sleep in late this morning and watch this video later, that is very bad of you. Okay, don't do that again. Get up early and do everything that you have to do as soon as possible. Says the one who prepared for this lecture 11 o'clock last night. Okay. So let's get started. So today we are going to look at unused tax losses. We are starting with that this morning. But before we get there, on Tuesday on Tuesday we were looking at disclosure and presentation, and I asked you to go and have a look at class example 11 at home. So just before we start now with tax losses, let's just quickly have a look at class example 1. So please get your notes and class examples and just open up to example 11, and let's just quickly look at specific things in that example that I want you to take notice of. Food. So firstly, what I want you to see in class example 11 is, so what I have here on the screen at the moment is I have the current tax calculation, so that's the yellow page. That's just a calculation, that's why it's yellow, it's just a calc. And then the white page is my actual financial statements. So the first thing I want you to realize and to know is the difference between the calc and the note. You will not believe how many students, if I ask them for an income tax expense note, they give me this calculation as the note. That's incorrect. That's just the calculation to calculate what the amounts are that should go into the note. So note that difference. And another thing that I want you to see, morning, just scan in for me there, please. Another thing that I want you to see is that first of all, in my current tax calc, so here we calculated our current tax expense for the year. You agree with that? But can you see that we had some temporary differences over here due to the differences between depreciation and wear and tear, differences between income received in advance and allowance for expected credit losses, etc., etc. So all those temporary differences, these temporary differences over here, the 96250, do you agree with me that that decreased my current tax expense? Okay, so that 96250 multiplied by 28%, it decreased my current tax expense to what we have here at the moment, 108850. Okay, but then we as accountants came in and we said, okay, but remember, the way we do our expenses and our income is actually more correct from an accounting perspective. So say, for example, SARS might say you get a deduction for computer equipment over 3 years. Is it still 3 years? It always used to be 3 years. But I'm going to say, no, my people are going to look after their computers. I want to use them for 5 years. So who do you think, whose timing is more accurate? When I looked into my crystal ball and I said, oh, I'm going to use my computers for 5 years. You think that's more accurate than SARS's just standard all computer equipment 3 years? Do you agree that the accountant's timing is the more accurate timing? Okay, so that's why we're saying, okay, for accounting or for tax purposes, we've got this saving now because of these timing differences, but the taxes timing is not actually the correct timing. So what we do is we adjust for that. So here we go, and here we have the originating and reversing of temporary differences. Now note that when you take this 96250 temporary differences in my deferred tax calc, and you multiply that with 28%, what amount do you get? 26950. Am I right? Okay, so this journal over here, this 26950 over here, actually comes from my, let's see, it comes from my deferred tax calc. So we had a deferred tax GL account, and we did our deferred tax calc, and we said, okay, that was our opening balance. We want our closing balance to be whatever. And we had to do a journal to that deferred tax account. And the other leg is this originating and reversing of temporary differences. But that amount is also the same as the temporary differences in my current tax calc. Not always. You'll see now that sometimes there are things that go into this amount over here, in addition to what we have over here. Okay. But I want you to see that this is the unwinding of the temporary differences, and that's the same as the journal that we have to do from our deferred tax to our income tax expense. Good. So what we have done is for current tax. Let me just get up. For current tax, we decreased the tax expense with the 96250. So that means this 108,850 is now a lower amount than what it would have been if there weren't any temporary differences. However, then we go with deferred tax and we increase it again. So we cancel that benefit out because we say, getting a benefit now, but remember in future you're going to pay that tax. Okay, so we're cancelling out these temporary differences. So when we get to our reconciliation between the income tax and the accounting profit, so when we get to this reconciliation, you will see now that none of these temporary differences that we had over here goes into my reconciliation because we have cancelled that out. Okay, so in my reconciliation, basically what I'm doing is I am starting with my accounting profit, and I am reconciling it to my tax expense. Okay, but the 108 as well as the deferred tax and the all the other taxes that I had to pay. So that's the recon that I'm doing. But I don't have to include these items in my reconciliation because they have already been cancelled out with my journal where I fixed my deferred tax closing balance. Okay. So if we look at our reconciliation, what you'll see, if we look at the reconciling items in our reconciliation, the first one we see is the dividend income. So the 22,400 is the tax on the dividend income. There's our dividend income. Next one is the tax effect of penalties and donations over here. There's the fines and the donations over there. Next one is the depreciation on the office building over here. There's my depreciation on the office building. So can you see that these items here at the top, that are not temporary differences, we couldn't fix them with our deferred tax journal. Therefore, they go into the reconciliation. And then we also have these other things because our reconciliation starts with our accounting profit for the current year. Therefore, everything that has to do with the prior year, like the under provision of the prior year, as well as the rate change from the prior year, those things also have to go into my reconciliation. And then we have our foreign withholding tax. Okay, so now we have this issue with our foreign withholding tax. So over here, we said that our tax was 3,750. That's the amount of foreign tax that we paid. And now we have this reconciling item over here for my foreign tax. So why do we have that? Did you have a problem with that when you looked at the example with the foreign withholding tax? Okay, apparently not, don't worry, but we are going to look at it anyway. But before we do that, I just want to stop there quickly and see if there are any questions further on this reconciliation. Let's see, there's a question on the chat. It says, when doing calculations for current tax or deferred tax, Do we necessarily have to follow the structure in examples? Or we can do anyways because it's a calculation. Okay, so I suppose what you are referring to is the format of this calculation over here. So these headings that we are using over here, the non-taxable items, non-deductible items, and the temporary differences. So because it's a calculation, obviously you can do it whichever way you want. However, you will see, I think it's one of your TUT questions that are coming up, where oh no, it's not that TUT question, but you'll see sometimes we specifically tell you that we want these headings in the calc. Okay, so we try and force you to do it in that format. And the reason for that is to make it easier for you to do your reconciliation. Do you agree that it was now quite easy to do that reconciliation and to check yourself if everything's correct? Because you know that these things will not go into the reconciliation, but these things will. Okay, so that's why we advise you to use that structure. And sometimes in a question, we will say, we want you to use that the structure. Otherwise, if we don't, you can do the calc however, but you have to just remember, if you do the calc de mekaar, then that's also fine. You just have to make sure that every time you put in something in your calc that is a non-temporary difference, that you put a little something next to it to remind yourself that these things should go into your reconciliation. Good. Questions from the floor in front of me? No? Okay, cool. So, yes, now I want to tell you about the foreign withholding tax. Let's quickly look at the foreign withholding tax. Okay, Ms. Willems, it sounds like you saying you did struggle a bit with the foreign withholding tax. So let's look at it again. Okay, so they told us that the tax that we paid was 3750. That's the actual foreign tax that we paid. Now remember, when we do our reconciliation, well, first of all, I forgot to point this out. In our current tax calculation, see here that we started with our profit before tax of 450. Let's say if we get to that. Okay. So we started with our profit before tax of 450, but we want to calculate what our South African tax is. So the 450 now includes my foreign income that I received. Do you agree with that? Because that's an income that I received. It should reflect in my splokkie. It will be part of my accounting profit. However, I'm not going to pay South African tax on that amount. That is the reason why in our South African current tax calculation, we had to deduct the foreign income so that we can start with our accounting profit that only relates to our South African income, which we will adjust to get to our South African taxable income. Does that make sense? Okay, cool. So that's the first thing that you have to see here, that in our current tax calc, for that foreign income, we had to deduct it to get to our South African income to calculate our taxable profit. So I'm not deducting it, still in my splokkie as income, just for my current tax calc, I'm taking it out. Good, so what happens now is included in that 450 is our foreign income of 25,000 rand. Now, the way the reconciliation works is it takes this 450, multiplies it with my standard tax rate of 28%, and it says, okay, if we were now doing matric accounting, then this would have been our income tax expense. However, this is not our income tax expense, this is actually our income tax expense. Now, let's think about it. If we just take the foreign income out of that calculation, we see that if we take the 25,000 and we calculate tax at 28%, it gives us a matric accounting tax expense of 7,000. However, the actual tax that we paid, the tax amount that's included in my income tax expense for the year is 3,750. So now that's why in our reconciliation, we have to say, okay, something's missing here between the 7,000 and the 3,750. And that's this amount, the foreign withholding tax, that goes into my reconciliation. Okay, so we say, okay, Foreign tax was not actually that high. It wasn't at 28%. It was a lower amount. Therefore, the difference between the 28% and whatever the percentage is that we paid the foreign tax, that difference goes into the reconciliation. Okay. Okay. So just on the chat there, I see that there's a question. Can you please indicate what rand value format in terms of the reconciliation means? So in this case, the reconciliation we did over here was in the rand format. However, we can also do this reconciliation in the percentage format. Now, you can do either one. Whichever one you want to do is fine. Out in practice, it seems as if companies actually prefer using the percentage reconciliation, because that does make it easier. If you look at it, then you get a feeling for what these adjustments are in the reconciliation. However, if most of the time we will tell you we want either this format or the rand format or the percentage format. If we don't tell you, then my advice is that you always stick to the rand format. Okay, make sure you know how to do the percentage format. But if I give you the option to choose, do the rand format, because in your calculations for the percentage format, you will have an additional calculation that you will have to do for each line item. So each line item you will have to go and divide by the profit before tax to get to the percentage difference. Okay, so stick to the rand format if you have the choice while you're studying. Otherwise, remember out in practice you can use either method. Good. How was the 3750 calculated? So that's the 3750 foreign tax. I think they gave that to us in the question, in the example. They told us what our foreign tax amount was that we paid, the withholding tax. So they told us this is the amount of foreign tax that you actually paid. Okay, yes, it was given. The question here, so the actual withholding tax value to be paid is added to the income tax expense note, and the difference between the income times 28% and the actual withholding tax paid is deducted in the reconciliation. Yes, because we are now reconciling the foreign income times 28% to what the actual tax was that we paid. So that's why we have to have that deduction. Okay, so it's a reconciling item. Okay, foreign withholding tax, warm fuzzy feeling. Okay, cool. I just quickly want to scan, see our participants here. Okay, because there's a rumor that some of our senior management are going to log into the CTA lecture and this lecture, just to have a look at what it's like and how it's going and all that. So please sound as if you're very excited and enjoying the lecture so much. Okay, that will really help my bonus for next year. Okay, so please enjoy it. Laugh out loud. And you guys over here at home, LOL, please. ROFL. RO, never mind. Okay, let's carry on. Okay, there we go. Everyone's having so much fun. Woohoo! Looks good. Good. Okay, so now we get into tax losses. So hopefully now, I'm hoping that you'll see now many things that we've already discussed when we up to now that will look familiar. But with tax losses, it gets a little bit tricky. So you have to be comfortable with what we've done up to now. So please make sure. Yes, ROTFL. I don't know what that stands for, but it sounds cool. Okay, so please make sure that you're comfortable and happy, so that the tax losses will not be as bad. So it's not difficult. You just have to understand the principles to get it. Good. So tax losses. So here we have an example of a company that has had an accounting profit, but then due to the adjustments for non-taxable income items and temporary differences, that this company actually ends up having a tax loss. So there's a tax loss for year 1, for year 2, and then eventually in year 3, they start making profits again, taxable profits again, which means they can now use these tax losses to pay less tax in future. Okay, so we see that the tax losses arise in the current tax calc. So the fact, we can see here they actually had a profit for accounting purposes, but because of the adjustment, they end up with a tax loss. Okay, and obviously they might have an accounting loss as well, which will just make it worse. But the thing is, what I want you to realize is that tax losses happen, or we calculate that in the current tax calc. Okay, and then what happens is, if we have a tax loss in year 1, so there we have our tax loss for year 1. Now we, obviously now we are not going to pick up the phone and phone the receiver and say, hey, I made a tax loss, so if I made a profit, I would have had to pay you money. No, I made a loss, now you have to pay me money. Doesn't work that way. So please do not do a journal where you say, debit, receiver of revenue, SFP, receivable account, credit, income, current tax income. Woo! Okay, please don't do that. You don't get an income from making a loss. What the receiver does say is, oh, shame, too much. You made a loss, don't worry. When you start making profits again, you can use this loss to pay less tax in future. You'll get that. Good, so what we do with this year 1 loss is we can carry it forward and utilize it in the next year. So next year we can say, okay, what profit did we make? We got the tax loss from the prior year, and that gives me then the taxable profit. However, in this situation, we had another loss in year 2. So these losses just then keep on accumulating, and then we keep on carrying them forward until we start making profits again and we can use them. Okay, so we just add the year 1 loss to the year 2 loss and carry that over to year 3. Here you can see that we would have paid tax on 55,000 in year 3. However, because we had these losses, we are only going to pay tax on 46,000. Good. So it's a benefit that we are going to get only in year 3. So now, please note the terminology that we are using here. So what we are saying is at the end of year 1, and then again at the end of year 2, we have an unused tax loss. So we had a tax loss, assessed tax loss, but it's unused. I can't use it yet. I can only use that tax loss when I start making taxable profits again. So year 1 and 2, unused tax loss. Then in year 3, we actually use that tax loss, or the tax loss is utilized. Okay. So we have an unused tax loss for years 1 and 2, and then we use or utilize the tax loss in year 3. Okay, so that's the first term that you have to know. If you see that in the question, if I tell you there was an unused tax loss of this amount, then you should know what we are talking about. And also note that if I tell you we have an unused tax loss, that is the amount before tax. Okay. So not multiplied by the tax rate yet. That's just the tax loss that we calculated in our current tax. So unused tax loss will be the tax loss amount before it's multiplied by the tax rate. Good. Now, what we see now is that tax losses reduces my future current tax. And we know that future current tax is actually deferred tax. Okay, and that's also why if you look at a definition of a deferred tax asset in paragraph 5, you will see that paragraph 5 says a deferred tax asset are the amounts of income taxes recoverable in future in respect of, and then we looked at deductible temporary differences in our previous lectures. Now we get to the carry forward of unused tax losses. Okay, and remember we said tax credits not applicable in South Africa. So we've already looked at what happens when we have deductible temporary differences. when we create deferred tax asset from that. Now we see that a deferred tax asset can also originate from an unused tax loss. Good. Is this a class example in the notes? I think this was just part of the an explanation in the notes. So it is there in your notes, but it's not a class example. Okay, so paragraph 5 in your standard, if we look at the definition, you see that an unused tax loss will also give us a deferred tax asset. Is this the same as an assessed loss? Yes. So if you have an assessed loss, then you have an unused tax loss. Okay, the assessed portion just means that the receiver agrees with your calculation of whether you have a loss or not. Okay. But do you remember when we looked at deferred tax for deductible temporary differences that we had the paragraph 24 limitation? You remember we said the moment we want to recognize a deferred tax asset, there should be some warning bells going off, ding, 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 watch out, a deferred tax asset is a promise that you are going to get economic benefits in future. So you cannot promise something if you cannot deliver it in future. So therefore, we had this limitation on a deferred tax asset for deductible temporary differences. Now, and that limitation said we can only recognize that deferred tax asset to the extent that taxable profit will be available, that it will be probable that this taxable profit will be available. Now we have the same limitation for my unused tax losses in paragraph 34. So paragraph 34, you'll see it looks very similar to what we had in paragraph 24 for the limitation for this deferred tax asset. Okay. So what does paragraph 34 say? It says a deferred tax asset shall be recognized for the carry forward of unused tax losses. So that carry forward from year 1 to year 2 and then again to year 3. To the extent that it is probable that future taxable profit will be available against which the unused tax losses can be utilized. So we will recognize a deferred tax asset from these unused tax losses, but only if it is probable that we are going to have future taxable profit. Okay, and that makes sense. Because like we said, it's a promise. We need to be able to use those benefits, get those benefits in future, otherwise we can't promise the benefits. Okay, so paragraph 34 limitation, the same as paragraph 24. And then we get some additional guidance again about when will it be probable. So we say it should be probable that we will have taxable profits in future. How do we know when it will be probable? And that we find in paragraph 34, IAS 12, paragraph 34. That tells us that first of all, so it says it will be probable that we will get those benefits. Firstly, then there will be sufficient taxable temporary differences. Meaning, in our deferred tax calc, we will have sufficient positive amounts, which will be the liability amounts, to absorb my tax loss deferred tax asset. If that is the case, so again, if I get to a position where I have a net credit total for my deferred tax, I don't have to worry. I can go and recognize that deferred tax asset from the unused tax loss. Also, what we have to look at, so these are just to make sure. So we're looking at criteria. So it's not an and. It is an or, and. So we look at these criteria, and then you look into your crystal ball that you get from CICA, and then you make your predictions about whether we are going to get it or not. So that one of the criteria that we'll look at is, do we have this situation? If we do, don't worry about it, recognize, make that promise. Okay, include that debit in your deferred tax amount. So make your deferred tax liability smaller. Okay, because you will be able to use this asset over here. Good. Next one is look at whether it's probable that the entity will have taxable profits before the unused tax losses or unused tax credits expire. Now, South Africa, your unused tax loss does not expire, and we don't have tax credits in South Africa. So therefore, if you think that you are going to make profits in the future, then you can, against which you can utilize this unused tax loss, then go for it. And then C, important, whether the unused tax losses result from identifiable causes which are unlikely to recur. So if I know why I made this tax loss in the current year, and I know that this is, so for example, we have an excellent example now. Many businesses did not have such a good year in 2020. Okay, so it was because of COVID. Because of the whole lockdown and all of that, especially our poor alcohol manufacturing and selling companies. Shame. So they didn't have such a good year, so they probably made a loss, or they could have now made a tax loss. But they know that things are going to turn around. So they'll say, okay, we'll probably still not do that well in 2021. But we are sure that from 2022, people are still going to drink. They are going to drink forever and ever and ever. So we know that it's probable that we will make profit again in future. Okay, so we know why we made the loss. And we also know that it's unlikely that it will occur again. So even if we know, yes, for the next 2 years it's going to be with us, but after that we are going to start making profits again, then it's fine. Then if your auditors agree with whatever you saw in your crystal ball, they look in their crystal ball and they see the same thing, then it's fine. Then don't worry about it. We can recognize that unused tax loss. Okay, and lastly, whether there are any tax planning opportunities available to the entity that will create the taxable profit. So even if things are not going that well, we've got some tax planning opportunities that we can use in future, which will enable us to use that unused tax loss. Okay, so these are the criteria that we look at. Okay, so paragraph 36, look into my eye, you guys as well. It's an important paragraph. Okay, know when can you recognize a tax loss or not. Good, let's quickly look at some questions here on the chat. Okay, there's a question. Okay, it seems you answered each other's questions there on the chat. At the end, we'll see if there are any questions that you still need to answer. Good. So what if we now looked at these criteria and we found that it is not probable. Sorry, not one of these criteria give me that warm fuzzy feeling that I am going to start making profits or that I will be able to use that tax loss in future. Then what do? Then paragraph 36 tells us that to the extent that it is not probable that taxable profit will be available, the deferred tax asset is not recognized. So there we have our limitation. So there we limit the recognition of our deferred tax asset. Okay, so if those 4 criteria does not give us certainty that we are going to use it, then we feel, okay, we can't make this promise, therefore we don't recognize it. Okay, and again, this will only come into play if in our deferred tax calc, if we put everything in there and we have our tax loss as a negative amount, and we end with a negative balance, so that is a debit balance for deferred tax, then we are making this promise. Then it's because then obviously this one didn't apply. We have to now decide whether these ones apply. And if they don't, then it says, "Ooh, watch out! You can't make that promise. You can't put the asset on your SFP." So therefore, we'll limit this. We're going to limit it to 0. Good. Um, so only one criteria needs to be met so that we can recognize an asset. So this is a little bit of a principle-based discussion. So it's not. So it's not just if you meet one, then it's fine, you can carry on. Although so like I said, this is just some things that you need to look at, some criteria that you need to look at. So yes, if you are confident with one of these criteria, then obviously you can recognize it. But sometimes you'll feel, I'm a bit, A is definitely not applicable. I'm a bit iffy about B, but C makes me feel a little bit better. And so can you see, it's not a, you have to discuss each of those criteria and think about each of those criteria to make that decision. Okay, and in the end you say, okay, based on what I've discussed now, yes, recognize. Or based on what I discussed, no, not going to make that promise. Good. Okay, okay, so what we have here, what paragraph 36 tells us is how we can recognize, when we can recognize that deferred tax asset. So if we include it in our deferred tax calc, up your, no. Outside your desk. Are we back? And we're unmuted. Woo! Okay, everyone back. And everyone's still there. How's it, Miss Marie? Thank you. Sorry about that. Those were just some technical difficulties, but we had a lot of fun here in the lecture venue while you were. I take my F back. What F? Never mind. Okay, so we had a lot of fun without you. Hope you had some fun at home too. I hope you quickly went to make some tea and went to go and pee or whatever you need to do so that we can carry on. Okay, so what I wanted to mention, tell you last thing on this slide that I wanted to say, the crystal ball predicted this, don't play with magic. I think that was the 8 ball. We used the 8 ball instead of the crystal ball. Never mind. Okay, so what we are saying here is we are saying when can we recognize this benefit? So if these criteria, if these are criteria applied and we're happy with that, then we can go ahead and recognize it. However, if they don't and we have to limit it to 0, then we are not, there will be a portion that is unrecognized. Okay, so now you have to understand the difference between unused and unrecognized. So now for unrecognized, when we talk about the unrecognized, you'll see if I tell you there's an unrecognized deferred tax asset amount of, then that is going to be the amount after tax. Okay, unused is the gross amount. The recognized amount will be after it has been multiplied with a tax percentage. Good, there is sound. Yes, there is sound, Mr. Mangali. Everyone else says there is sound as well. Good. So now we know when we can recognize. But now there's another paragraph here in IAS 12, paragraph 35, that just gives us an additional warning. That just warns us and says that, yes, look at these criteria. They are the same as for deferred tax assets arising from deductible temporary differences. However, note that the existence of an unused tax loss is strong evidence that future taxable profit may not be available. So you will have to be a little bit more certain of your reasons why you feel you can recognize a deferred tax asset from an unused tax loss than you would be recognizing a deferred tax asset from deductible temporary differences. Okay, because if you are now making tax losses for a few years already, then that's quite strong evidence that things may not turn around. Good. And that's also why we say that if you say, okay, I'm going to make profits again in 10 years' time, that's a little bit, I know it's 10 years, but that's for such a long time. Many things can change until then. So that doesn't really give us that warm feeling to say, okay, we are happy to make this promise. Good. So we need convincing evidence. Okay, if we want to recognize a net deferred tax asset, then we need more convincing evidence if it's from an unused tax loss. Okay, and then there will also be additional disclosure that we have to do from paragraph 82. Good. And then also IAS 12 tells us that every year we have to assess our unrecognized deferred tax assets and again have to decide should we now recognize or shouldn't we. Every year we do our deferred tax calc, we put in our unused tax losses and make the decision every year. So you can't just make it once when it happens, you have to make a decision every year if it has to go onto your deferred tax calc. Okay, so if we get back to that example that we had, Hendrik, I'm sorry, but it is freezing. The screen, the PowerPoint screen has frozen. Oh, daar gaan hy. Yes, okay, cool. Okay, so if we go back to this little example that we looked at, that example is in your notes as a just an part of the explanation. Same one we had at the beginning of the lecture. Sorry. And we stop at the end of year 2. Sorry. Not COVID, just a little bit of frog and throat, don't worry. Don't send flowers yet. Okay, so if we stop at the end of year 2, and we see that now at the end of year 2 we have an unused tax loss that is going to decrease my future tax. Okay, so we are now standing here at the end of year 2, and okay, my hair is a little bit longer than that. Okay, we are standing there at the end of year 2, and we've got this unused tax loss, and we know that that is going to decrease future tax. And we looked at those criteria on paragraph 34, and we are happy we can go and recognize that deferred tax asset. So now we go and we recognize. Good. So, for example, what could happen, if you see there, at the end of year 2, when you do our deferred tax calc, so that's our deferred tax calc. In this situation, we have enough taxable temporary differences. So these are taxable temporary differences. So giving me a deferred tax liability. It's enough to absorb my unused tax loss. So you'll see the unused tax loss does not have a carrying amount. You didn't do a journal or anything for that unused tax loss. But it is a benefit that we are going to get in future. So it has a tax base. So therefore, we've got a deductible temporary difference. And if we multiply that by 28%, we see that our taxable temporary differences are enough to absorb my tax loss. So therefore, I'm sitting with a net liability for deferred tax. So it's fine, I can go and recognize it. Good, the full amount has been recognized. It's unused at the end of year 2, hasn't been used yet, but I can go and recognize it. Cool. Here's another example. So here's another example. So here, my taxable temporary differences that we have over here are not enough to absorb my unused tax loss. However, now I've looked at those criteria from paragraph 34, and we look at those criteria and we say, okay, but we know this was just a contract that went bad this year or whatever. Just because of COVID, next year things are going to turn around. We can sell our ciggies again, and we can sell our gin and tonic again, so everything will go well. So next year we'll make profits again. So then we decide, okay, then we can make this promise, and we can put this net asset. I used to always abbreviate asset, and then I realized that's not a good idea. So now I take the pains to write out the entire word. So now we can go and recognize this asset because we know, we look at paragraph 54, we're happy, go ahead, make that promise. I solemnly swear that this deferred tax asset is going to give us benefits in future. Good. So both of these cases, we are recognizing the entire unused tax loss. Can you see it? Good. However, sometimes we cannot recognize it. So what do we do with an unrecognized, unused tax loss? How does that work? That is when we have a portion or the full amount that cannot be recognized as a deferred tax asset. So if we have the same situation that we had here at the end of year 2, our taxable temporary differences are not enough to absorb the debit. We should be sitting with a net asset amount. However, we cannot make that promise. Therefore, we say, sorry, stop the bus, limit the recognition. We cannot create an asset, so we have to stop the value at 0. So what happens here is of that 2520, we have 280 that is recognized. So that 280 cancels out the 280 taxable temporary differences. Good. But the remaining 2240 is unrecognized. Can you see that? Unrecognized. Okay. So now also important, even though it's unrecognized, it doesn't mean we don't have it anymore. Remember, SARS does not worry about our deferred tax calcs at all. So we still have that benefit. We just don't know if we're going to be able to use it. Okay. So it's like we might have a spaceship. The 17 of us, or however many we are here in the class. Not you guys. You are at home looking at our business and feeling what's the word when you get green? Envious. Good. So we might have this spaceship. Yes, we've got this huge asset. We've got a spaceship. But will we be able to use it? Will we be able to, well, I don't know, what do you do with spaceship? Put people on it to send them to Mars or whatever. We might have this technology, but we can't use it. It's still an asset, but I'm not going to get the economic benefits from it. And that's exactly what happens here. We have this unrecognized portion. It's still an asset, but we can't recognize it. Good. So we have to remember about it. And also we have to disclose that in our financial statements to tell the users, there is still this benefit, but at the moment we cannot recognize it. Good. And remember, unrecognized, the recognition is after we have multiplied by the tax rate. Good. Not really that envious. I have a blanket and hot chocolate. Okay, Mr. Mangali, I am kicking you out of the session. There you go. Don't want to hear about your blanket and your hot chocolate. Okay, so that is then the principles about a tax loss. So now we can look at class example 12, which is a basic tax loss example. Good. And I've just realized you didn't have a lecture after this one, am I right? Or do you have a tax, but it's online? Nothing. So we can carry on forever and ever and ever and ever. Counting is so much fun. Good, so we're looking at class example 12. You wish you were us. No, I've got my crystal ball, Mr. Armstrong. I'm sorry, you still have to get yours. So I'm not envious of you. Okay. Good, cool. Class example 12. Have you all got your class example 12 open in front of you? So in class example 12, they give us information. So it's a little bit small there, but at least you have it open in front of you. So this is the information from the question. They tell us that the credit balance on the deferred tax account on the first in the first year is 1,400 Rand. It's a credit balance, so it's a liability. And then they give us our profit or loss before tax for each of these, of the next three, or for the 3 years, X1, X2, X3. And then they give us temporary differences for plant and machinery for year X0, 1, 2, and 3. Okay, so we see the difference between the carrying amount and the tax base. They tell us there are no non-taxable or non-deductible items for any of these years, and we have a tax rate of 28%. Good. Lekker, Mr. Armstrong. Got you there. Good. So now from this, we are doing our current tax calc. So again, note that it's a yellow page. So it's just a calculation. You don't give me this current tax calc as a note. I will phone your mother. Oh, even worse, I'll phone your grandmother. She will be very upset because she's so proud of you. My son is in 3rd year and he's doing so well. Okay. My grandma's dead. I'm so sorry, Mr. Schreiber. Okay, mine will. I also have a dead grandma, so thank you. Good. So there's our current tax calc. Okay. Okay. So let's just see at this current tax calc. How did we get there? There's our profit or loss that they gave us over here, and then our taxable temporary differences. The wear and tear will be, if we take the difference from the tax base for X0 to X1, to X2, and to X3. So can you see that wear and tear allowance is 25,000 Rand per year. So there we have our wear and tear allowances. And our depreciation would be the movement of the carrying amount from 80 to 60 to 40 to 20. There we go. Good. And that gives us then our taxable profit or tax loss for these 3 years. Goed, arme ouma. Yes, arme ouma. Okay, so now from our current tax calc, we can go and start with our part 1 of our income tax expense note. So this is the note that goes into our financial statements. Here we say, okay, for X1, our current tax expense was 1680. For year 2, current tax was 0. And for year 3, current tax is 1540. So note that for year 2, we had this tax loss, this unused tax loss. Now, again, if you give me a current tax income over here, if you give me an amount, a negative amount of 9,500 times 28% for year X2, I don't know who I'm going to phone because it seems like you've lost most of your important family members. Well, at least Mr. Schrempel has. So I don't know, I'm just going to have to break your fingers. Okay, so don't do that. Don't give me an income amount for when you have a tax loss. Good. Don't do that. Not sure? You all got that. Call the VC. Good. No bonus. For me. Anyway, never mind. Sorry, distracted. I'm back again. Sorry, guys. Good. Now our deferred tax calc. Let's look at our deferred tax calc. So what we do with our deferred tax calc, we are going to compare our carrying amount to our tax base for every year. So for year X0, there we had our carrying amount and tax base, carrying amount, tax base, blah, 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 blah. And that's exactly what we have over here. We put in our carrying amount and our tax base for every year. But now at the end of 20X2, we had this tax loss, this unused tax loss, this benefit that we are going to see if we can recognize that benefit, if we can make that promise. So you'll see here for X2, the tax loss does not have a carrying amount because we didn't do a journal. We didn't put that income and receivable with a journal in our SFP. So our carrying amount is 0. Our tax base is a future deduction, a future benefit of 9,500, giving me a deductible temporary difference of 9,500. Multiply that by 28%, gives me my deferred tax asset amount of 2,660. It is being absorbed by my deductible temporary or taxable temporary differences from my plant and machinery. So I'm sitting with a net credit balance on my deferred tax account, so I don't have to worry. I can recognize the full tax loss. Okay, now what happens next year? In the next year, if we just quickly go back to our current tax calc, in the next year, in year 3, you can see that we have now used that full unused tax loss. So in X3, I'm using the unused tax loss. So in X2, it was unused, 9,000 Rand unused, but it was recognized, 2,660 benefit recognized. You see that? Good. But now in year 3, I am using the 9,500. So when we do our deferred tax calc at the end of year 3, we don't have a tax loss anymore because we've used it all in X3's current tax calculation. Can you see that? So therefore, a 0 tax base for tax loss at the end of X3. Therefore, my deferred tax is going to just be from my taxable temporary differences from my plant and machinery. Good. Now, if we look at our income tax expense note, now we can go and put in our deferred tax movement into our income tax expense note. So we started off with a deferred tax liability of 1,400 Rand. And then at the end of year X1, the balance should be 2,800 liability. So there's our deferred tax. Oops. For X0, beginning of the year, we start with a 1,440. 440, I think it was. 140. Oh, man. Let's try again. Deferred tax SFP account for X0, 1,400 credit balance. Now we know that we want this balance to be at the end of X1, we want it to be 2,800. So therefore, we are going to have to do a journal in X1 of 1,400, and the other leg of that journal goes to my income tax expense. So it's a credit in deferred tax and it's a debit in income tax expense for the X1 year. Good. Now, the movement from the 144 to the 28. Now what happens in the next year, now we've got the movement from 2,800 to 1,540. So now that balance needs to get smaller. So we want our balance now in X2 to be 1,540. X2, 1,540. So to get there, what do we need? We need to make our credit balance smaller. So we need to go and say 1,260. So for X1, we've got, no, X2. Sorry, for X2, but 1,260 to make the credit balance smaller to get to the 1,540. You see that? Now, notice that actually what happens here is if we ignore the tax loss, then our movement would have been 1,400, 1,400, 1,400. Just from the reversing and the originating of the temporary differences for plant and machinery, we have this 1,400 amount that our liability is going to grow with every year. But because of the tax loss, we actually now have an additional amount in there. So this 1,260 over here actually consists of, for X2, it consists of a 1,400 credit as well from the reversing of the temporary differences, and it consists of the 2,660 benefit from the deferred tax, from the unused tax loss. So these two amounts, we don't do the journal separately. Please don't do the journal separately. I'm just trying to show you that this 1,260 consists of the 2,660 debit and the 1,400 credit. Got it? Good. And then again for year 3 is going to again increase with now moving from a 1,540 balance to a 5,600 balance. We need to increase our deferred tax liability with 4,060. Okay, so in our current income tax expense note for deferred tax, we've got our movement here for year 1 from 1,400 to 2,800 is the 1,400 movement. So we went, here's our journal, we went credit liability, debit income tax expense. And this is the debit to income tax expense. Next year, with a movement from 2,800 to 1,540, that movement, we went and we said debit deferred tax, and we would have credited my income tax expense with a 1,260. So there's my credit, my 1,260 benefit that I'm showing now, my promise that I'm making, the other leg of the promise. Okay? I'm promising that actually we did have this income, and it is going to, in future, we're going to get the benefit from that. And then last year, movement from the 1,540 to the 5,600, that movement is then the 4,060. Can you see that? Good. However, well, yeah. But what I want you to see now, remember I showed you when we looked at class example 11, that when we looked at the total of our temporary differences, that agreed to the movement for deferred tax that went to my income tax expense. Do you remember that? I showed you that at the beginning of the lecture. Good. I hope you remember it because only 2 of the students in front of me seem to remember it. It was only an hour ago. Never mind. But anyway, now if we look at what happens now, we see that now we don't get that. So for X1, if we take the 5,000 and we multiply that by 28%, yes, it gives me the movement. Good. However, if I now take the 5,000 again for 20X2, and I multiply that by 28%, I get 1,400, and here I have 1,260 income. Okay, but remember that this 1,260 income actually consists of the 1,400 less the 2660, giving me the 1260. Okay, so these two amounts give me the 1260. So this 5,000 times 28% is the 1,400, but then we also have the additional tax loss that creates that difference. Good. And then because the tax loss, if my movement over here for 2x3, if the movement was just from 4,200 to 5,600, then the difference would have been 1,400. However, now the movement is, and then we've had 1,400 over here, which would agree to that 5,000 times 28%. But because my opening balance is 1,540 after I've recognized the tax loss, the movement from here to here is 4,060. Okay. So in 20x3, that movement is the 1,400 for the temporary differences, plus then the 2660. Wait, now so it swings around because I've used it. The benefit is now not there anymore. I've used it. Okay, everyone happy with that? See, what would the account be for the 1260? What would be the journal there, the 1260, we will debit our deferred tax in order to get to our closing balance that we want from 1540, and the credit will go to my income tax expense. Yes, I. Thank you, Mr. Armstrong. Cool. Good. Okay, so now back to our income tax expense note. Now we've got this is our part one of the note that we all know and we're all happy with. But now we get to part B of part two of the note, the reconciliation. So let's have a look. Do we need the reconciliation in this situation? Do we need to do that recon? If we remember now our recon will be where we have to, we take our accounting profit, multiply that by 28%, and we agree that to our total for my income tax expense. Okay, so if we look at 20x1, if we take our accounting profit of 11,000, and we multiply that by 28%, we get to 3080, which is the same as the amount that we have at the moment for my income tax expense total. So can you see that for year one, these two amounts are the same? Good, let's do it for year two. If we take our 1260 tax income and we compare that to our tax or our accounting loss of 4,500 times 28%, we get to the 1260. And the same for year three. If we take our 20,000, we multiply by 28%, we get to the 5,600. So can you see that for all three of these years, these two amounts are the same? Why are they the same? Why do I not have to do a reconciliation in this instance? What do I not have? Maybe you guys at home with your hot chocolate can help. Or are you sleeping already underneath that blanket? There are no non-temporary differences, no non-taxable or non-deductible items. Exactly. So we don't have any items. The difference between the accounting profit and the taxable income we could fix with deferred tax. Okay, can you see that? Okay, and also another reason is the fact that we were able to, let's go back to here, the fact that we were able to recognize the full tax loss. The fact that we were able to do that also said we could, so we were able to show that benefit, that full benefit, and recognize the full benefit. If we have a situation, which we will get to on Monday, where we are not able to recognize the full amount, then you'll see that now we need a recon. Now we need to say, okay, stop the bus. There's a reason why if I take my accounting loss multiplied by 28%, why it doesn't agree to my income tax expense, and that's because a portion of my unused tax loss I could not recognize as an asset. Good. In the 20x2 splokkie, do we show the tax expense as 0 or as 1260? No, in your splokkie, this total here at the bottom of your income tax expense note, those totals are going to be the totals on the face of the splokkie. Okay, so this note explains to us what the totals on the splokkie consist of. Okay, so in your splokkie, you will have for X2, you will have an income tax income of 1260. Okay, we don't have a current tax income, but we have an income tax income because we were allowed for DEF to recognize that benefit through deferred tax, resulting in an income. Good. Questions on the floor? You guys are so quiet. They promised me that it's going to take a week and then everyone is going to take over the class. It's not yet happened. Okay, I feel as if I am lecturing to my dead Oma. Okay, although she was a lot of fun. Okay, she was really a lot of fun. Yes, my children are very worried that I'm going to be like her when I get older, which I probably am. I'm going to embarrass them a lot. Okay, let's see on the chat if there are any questions here. So would it appear on the face as a positive 1260? Yes. Okay, so it will be a positive amount for my income tax expense. Well, there are only a few dozen to 100 students in class. Yes, let's say a few dozen to 100. Good. Okay. Let's see what else do I need. Okay. So that's it now from for tax losses. We will get into that in more detail in Monday's lecture. However, I want to just make a few comments on some of your homework questions. Can we do that? Are you ready for that? Okay, so first of all, let's just first take a deep breath and absorb what we have learned about tax losses. Okay, have you got it? Good, now we can move on. Okay, so question 2, your homework question 2, was a bit of a cheat, actually, I think. In retrospect, I think you should actually have only done question 2 maybe after today's lecture. But never mind, it gave you some exposure to a situation that you're unsure of. Because remember, I always say, BCom accounting students are the best and the cleverest, the slimmest students in this university. But that is not necessarily always a good thing, okay? Because, especially coming from school, you guys all used to do very well at school, but it's to me it's sometimes as if a BCom accounting sciences student, if they can't get 90%, they get 30. It's as if they don't know how to get 60%. Okay, so either they have to be in a position where they know everything, they know exactly what to do. There's my question, or answer to this question. If they go and then they don't know, they go, oh, and then they can't do anything else. Instead of going Never mind. Okay, so that's the thing. You have to put yourself in that. That's why you have to do questions without looking at the solutions. Okay, I'm looking at you, and you're telling me, yes, you know we have to do it that way, but I promise you don't. But that is what a good student does, and you are all good students. I see you laughing. Okay, feeling guilty. Yes. A good student does that. A good student looks at a question without looking at the solution because a good student wants to know what is it that I don't know. Okay, so never mind. So that's just some preaching here from me on the side. Let's look at question 2. So what happens in question 2? What happened there? So we had a situation where the accountant did the current tax calc in the prior year and okay, we've got a tax loss. However, then in the next year, the receiver came back and said, no, wait a minute, sorry, your calcs are wrong. You actually have a tax profit. Okay, did you see that in question 2? Did it make you think and wonder? Okay, and excited to think, oh, here's something I don't know. Let's figure it out. Okay, so what I want you to see here, what happened was, So the accountant said we had in the prior year we have an assessed unused tax loss. So the accountant went and recognized this tax loss in the deferred tax count. Okay, so the deferred tax liability was smaller because the accountant recognized this deferred tax asset. So the movement from zero current tax to this deferred tax asset, or to the loss, was recognized as a deferred tax asset or a debit. However, now the receiver comes and says, sorry, no, you actually have a profit. So for current tax, we provided for current tax in the prior year. We said, okay, we have a loss, so we don't have to pay any current tax. So our current tax in the prior year, we said, was 0. However, our current tax should have been 30% of 10,000 Rand. So the movement from the 0, let me get another color. So the movement from the 0 to the 10,000 Rand is an under provision for current tax. But we didn't just leave it at the 0, we actually recognize a deferred tax asset. Whoops, sorry. We actually recognize a deferred tax asset. So therefore, the movement from the 0 to the 3,000 deferred tax asset is then a deferred tax under provision. My deferred tax liability should have been bigger, so I underprovided for deferred tax. Can you see that? So yes, the difference is 20,000 Rand in total, from a -10 to a +20. However, the under provision for current tax was 10, and the under provision for deferred tax was 10. Good. So here we see that our unused tax loss over here was recognized. So our deferred tax liability would have been bigger, but we decreased it with 3,000 Rand. Okay, and then we also had the rate change, the rate adjustment. So here it was 30%, and here our rate change is 29%. Now, important that we are not now going to pay that extra tax for last year at 29%. We are going to pay it at 30%. That was the tax rate of the prior year. Good. But this 3,000 in my opening balance for deferred tax, we adjusted that to 29%. So that 3,000 now opening balance at the beginning of the current year, that 3,000 we made 2,900 opening balance. Agreed with that? Okay, and then in the current year, it's not there anymore, it's gone. So that means our movement in deferred tax would be 2,900. That our opening balance over here was too small. It was underprovided with 2,900. It should have been bigger because we should not have had this unused tax loss in our account. Okay, so the movement from here to here should have actually been a 365, a smaller movement, because this balance was supposed to be higher with 2,900. Good. So in our income tax expense note, we see that here we have our, so this is now in the current year, so here we have our under provision of current tax of the prior, the 3,000 additional that has to go in. But we now, in this year, we're showing it as an expense, although it actually pertains to last year. Remember, this is not an IAS 12 prior period error or change in estimate or anything like that. IAS 12 specifically excludes it from IAS 8. And then over here, in our movement from our opening to our closing balance, is our difference of 2,900 included in that movement. Okay, because remember, this movement would have been smaller. This movement, because our opening balance would have been a higher amount. Our opening balance would have been 3,4,220 plus the 2,900 that we were not actually supposed to recognize. So then the movement from here to our closing balance, have I got it right now? Yeah. Moving from here to our closing balance, that movement would have been a smaller amount. Now it's 2,900 extra, and that's the over provision or the under provision for deferred tax. Okay, so in our reconciliation, our part 2 of our note, you'll see that here we put in our under provision for current tax, the 3,000, which is that 3,000. And here we have our under provision for deferred tax, which is the 2,900. If our rate had not changed, then this would have also been 3,000. But because our rate has changed and we adjusted that opening balance, the amount is now 2,900. Good. Okay. So that was just something interesting in question 2 that had to do with the tax laws. Okay, I've got a question on the floor. Yes. You just want to tell me that you're enjoying the lectures and. Okay. Cool.
Change in the rates reflects the change in the assets rate and multiplication. You don't have to go and calculate the deferred tax asset that you have to adjust now at 20 months. You don't have to do that at 20% because that is already included in the general rate.
Okay, so the question is that that under provision of deferred tax, we actually provided for that at the old rate of 30% in the prior year, and now our adjustment is at the new rate of 29%. So, so the question is, why is that, or do I have to take the? You feel you want to take the 30,000 divide by 30% times 29%? Okay, but that's exactly what we are doing. That's exactly what we are doing, because if we take away all the other amounts in this tax calc, effectively what is happening in this deferred tax calc is we are saying we've got the 3,000 debit amount, the asset amount, that we are dividing by 30%, multiplying by 29, giving me the 2,900 over here. Okay, so included in this 342,200 is the 29, included in the 354,000 is the 3,000. So now at the end of the next year, of our current year now, our deferred, tax loss is now not there anymore. So with regard to the tax loss, if we take out all the other things, the balance will now be 0. Okay, so the movement from the 2,900 to the 0 is due to this under provision for deferred tax. Okay, and that's why we use the 2,900. Okay, hope you got that right. Question on the chat: why is the tax base for unused losses minus 10,000 as 0 minus would give a positive? Okay, because remember, where is my? You are now trying to so why is the tax base for unused tax losses minus 10,000? As 0 minus 10,000 would give a positive temporary difference of 10,000 and not a minus 10,000. Okay, so you are now using the tax base calculation for a liability to calculate what the tax base of a tax loss should be. So remember, this tax loss is a future deduction. You'll see, I can't remember which paragraph it is now. It's there right after the definition or the formulas that they give us for the tax basis. Just quickly find that. Current tax, sorry. Where's that paragraph? Okay, it's paragraph 10. I think I can't remember if paragraph 10, if we specifically excluded that, but just so that you know, in IAS 12, paragraph 10 says, where the tax base of an asset or liability is not immediately apparent, it is helpful to consider the fundamental principle upon which the standard is based, that an entity shall, with certain limited exceptions, recognize a deferred tax liability or asset whenever the recovery or settlement of the carrying amount of the asset or liability will make future tax payments larger or smaller than they would be. So we are saying, so here we are actually, our unused tax loss, I see the problem. Okay, so this unused tax loss over here, the fact that it is in brackets is a bit misleading. Okay, so it's actually because it's a future deduction. So therefore, the tax base should actually be a positive amount. But remember what I told you, I said to you, we don't, when we mark, we are not really worried about the signs in these columns. We are only worried about the signs in this column. Come on. Okay, the signs in this column. That's what we are worried about. So here we want the correct sign to show that it's a deductible temporary difference. But I agree with you that actually, to make it technically more correct, this tax base should have been a positive amount because it's a future deduction. But what paragraph 10 tells us is sometimes it's difficult to determine, to use those formulas. Remember, those formulas are trying to be generic. They're trying to cover any type of asset liability transaction that we might have. So sometimes we might have things that don't really fall into those generic formulas. And then paragraph 10 says, well, just stop the buzz, relax about it. Think about what is the future tax consequences. And that's what we want in our temporary difference column. So, yeah, so we would have, so this is correct. We want this to see that this is a deductible temporary difference in tax loss, but I agree with you that maybe this should rather have been a positive amount. On that point, you will see many times in your questions, your homework questions, that sometimes the carrying amount of all assets and liabilities are all put in as positive amounts. Have you seen that? Seen that sometimes the carrying amounts and the tax basis are all put in as positive amounts, and then when we get to the temporary difference, then the signs are correct. Okay, so that's and that I think I did mention that to you in the previous lecture. So the thing is, we are just worried about the signs in this column, but to make it easier for you to do it in a test or an exam, I suggest you put your assets as positives, your liabilities as negatives, and the same with their tax basis, so that when you do that calc, you get to the right answer. Good. Next question over here. How's our time? Let's check our time. Oh, our time is up. Let's quickly scan, see if there's an important question or a cool question. Unused tax loss can be classified as a deductible temporary difference. Yes, unused tax loss is a deductible temporary difference. It is a deductible temporary difference, but it's a deductible temporary difference as a result of the tax loss. Okay. Good. Okay, then I'm going to leave it there. Our time is up. Thank you for joining me. Press like at the bottom. Click on the link here if you want to read more. Okay, and yeah, see you all then on Monday. Enjoy your weekend.